government has waived off registration for hybrid vehicles. Maruti, of course, is pretty big in hybrid vehicles, so we'll look at those two names as well as we start. Nifty is starting about, 20 points higher. 24,335 is where the Nifty is at. It's a flattish to slightly higher start. The Nifty Bank is up 50 points, 70 now, so picking up a little bit of pace, 52,500 on the Nifty Bank. Mid-cap index is up about 335, and I think you've got the small-cap index, which is also starting higher. So this is a better start, at least on the frontline indices, as compared to what you had over the last two trading sessions now. So those are indices, but as always, let's get to stocks.
Okay, get into individual stocks, right? Godrej Consumer really is the one to look at. It's a flattish sales growth and double-digit EBITDA growth that Godrej Consumer has seen, so the stock is also flat. MGL has hiked CNG prices by 1.5 rupees a kilo. So, that stock is up almost 3% right now. They've hiked PNG prices as well. Nestle, the shareholders have approved an unchanged royalty payment of 4.5% to the parent company. So Nestle is in the news. Utkarsh Small Finance Bank, the RBI has approved Govind Singh's reappointment as the MD and CEO for 3 years. So Utkarsh Small Finance Bank is up almost 1%. Inox Wind has bagged a 200 megawatt order for its latest wind turbine generator. Pitti Engineering has launched a 360 crore QIP with the floor price at 1,054. So keep an eye out on that. On the downside, Concor has seen its domestic volume growth of 15% and EXIM growth at 3.3% in Q1. Jupiter Wagons has launched at 800 crore QIP, so with the indicative price of 655 rupees, so keep an eye out on that. And a couple of others like Polyplex, the production at its manufacturing plant in Uttarakhand was suspended because of the rainfall. So Polyplex could be slightly soft, but not too much actually. But it's good to see the market really picking up pace. Sensex holding well above 80,100. And the Nifty now, look at that, 40 points higher. Good start in the green.
Well, that's right. Good start in the green. We'll keep an eye out on the 24,440 odd mark. That seems to be a bit of resistance zone. That's on the headline index. But a few stocks that are moving around from the broader markets. LT Foods and KRBL, I don't know what's happened there. But both those two stocks, they're some of the biggest gainers and the volumes are rather large. So we'll try to, pull in one of these managements. Pull up KRBL as well, LT Foods as well as KRBL. Massive move is what we're seeing on both those two stocks. HPL Power, well, there was an analyst meet. They earlier were guiding for around 2,300 crores of revenues. They've cut it by closer on 200 crores. Now they're talking about 2,100 crores. So that explains why that stock is down by closer on 2.5%. They say they'll hold on to margins of around 19% though. Affle India. Citi has initiated coverage, buy rating, target price at 1,600 rupees. They believe that the company is possibly leveraged to digital ad spends. So that's why they have this big target price out there. And that stock is up closer around 6%. Swan Energy, we saw a large trade that took place yesterday. BlackRock Global Funds India as well as BlackRock Emerging Frontiers Master Fund. Together, they had acquired closer on 1.3% stake in the company. So that's why, in fact, BlackRock making an entry out there. The street likes it, was up 5%, is up 5% today. Patel Engineering, that's another stock that's bouncing back today. Yesterday, it was down close to 10%. Today, it's mildly in the green with a gain of close to around 3% odd. A couple of other notable movers. Well, you have Crompton that's up close to 3%. It's a good start for Crompton. And RCF that was up close to 10% yesterday. I think the start was well in the green on that one as well. Prashant?
3.5% on RCF to start with. So 235 on that one. We're up 40 points now. So it's looking good with the index at about 24,365 and lots and lots of movers. Well, guess what? The 2 or 3 top volume-led gainers are all a repeat of what we saw yesterday. RVNL, IRFC, RCF, NFL. I mean, throw in a Cochin Shipyard, which took a break yesterday. It's up, back up about 2.5%. So yeah, I mean, that space is doing well. GE Shipping went up 6% yesterday by close. It's up another 4% this morning. I think we mentioned Affle. Well, Cochin I mentioned, but look at Garden Reach as well. So 2% on Garden Reach, starting higher. There is Inox Wind, which is up about 5%, 165 on Inox Wind. KPIT Tech is up about 3%. Torrent Power is up 5%. Maybe we could look at, by the way, Maruti is up about 3%. I think the trigger is the fact that Uttar Pradesh essentially has waived off registration fees for hybrid vehicles. And I think UP is about 10% of Maruti's volumes. So it is definitely at the margin a positive for Maruti. So that's a There's a big mover. And look at CESE as well, which I was talking about. There is a tariff revision which has taken place, a tariff adjustment rather, higher. And the stock starting about 3% up. I mean, as compared to some of the other power utilities, it trades at a significant discount. So keep an eye out on that one as well. Apart from that, I mean, volumes thin out. As you go down the list, volumes thin out. But just to spot one or two names, Paytm, which had a big 10% surge yesterday, is pulling back 3%. And I think Jupiter Wagons, we were highlighting that in the morning, 3% lower. BEML is down about 1.7, but these are all reversals after yesterday's sharp surge. Shakti Pumps was down about 5% yesterday, and this morning it is down about 4% or so as well. So this is, overall what you have going on. We have Anand Shah, who's joining us now, head of PMS and AIF Investments at ICICI Prudential Asset Management Company. Anand, good to have you with us here. Thank you very much for your time. Is the view broadly at the the AMC and the alternatives desks largely similar, Anand, or is there a divergence? The reason I'm asking is because we've been speaking with the AMC team, and I've spoken to them recently, etc. as well, and generally the view is a little cautious because of the run-up that we've had, especially small caps, mid caps, and preferences now to sort of rotate into some of the larger caps. Where do you stand, Anand? Let's just begin there. We, by the way, recently had an instance of a mutual fund which had stopped inflows into a small cap scheme for a couple of months, which restarted it. I mean, just a testament to the fact that the market just has rallied on and money is coming in. Your thoughts, Anand?
Hi, very good morning. Pleasure to be here on CNBC. Thank you. I think the risks are increasing. I think there's no doubt in anybody's mind that liquidity is, drawing into markets in general. Having said that, large caps do have a counter weight of FIs selling, and to that extent, the valuations and the sharpness with which the large caps have moved have been far more muted than what's happened in the mid and small. And within mid and small caps, there are umpteen number of examples where we can actually now see the valuations are just beyond what can be explained through fundamentals. So no doubt in my mind, or for that matter in anybody's mind in our asset management company, that risks are ever increasing with every such bout of liquidity flowing into the equity markets in general, and mid caps and small caps in particular.
Okay. By the way, AFL is one stock that's really gaining ground now. I think it's up 4% right now. Citi has initiated a buy on AFL with a target price of 1,600 on the stock, which is a big upside to the current market price. They talk about mobile ad budgets, which are picking up quite a bit across the industry and across businesses that are digital first, businesses that have omni channels, etc. So that will benefit AFL in a big way. Just wanted to point out that stock. Anand, hi, good morning. The big event is the budget, right? I know we talk about it a lot, and because that's our job pretty much, to analyze it threadbare. But from an investor standpoint, is there anything that this budget can bring about which could sort of change track for the market?
I've been saying this, that the budgets over time have been more consistent, and to that extent, the incremental surprises that come out of budgets have only decreased. And we believe there is more continuity of policies, more continuity of governance, or the direction of the economy would not change or alter significantly. Albeit, yes, we are looking at a couple of things which, particularly for middle class, we can have some bit of simplification of the tax. Definitely, that's one of that. And that also means that you might see a lower tax rate to support the weakness that we have been seeing in the consumption at the bottom of the pyramid. So I think there will be some bit, but on a broader level, I don't see the investments on infrastructure, the investments or the PLI benefits coming into further induce manufacturing, support the housing. I think this would be the pillars. Urban infrastructure, supporting housing, and supporting manufacturing, because all these three has a lot of potential to create jobs at the bottom of the pyramid. Because once we are able to sustainably do that, do more urbanization, then the consumption will anyways pick up. So I'm not too worried about consumption as long as we continue to invest in these three segments of the market which are generating jobs.
Hi, Anand. Good morning. And, a couple of notes believe that the central government has enough ammunition to please all. So let's hope that is the case. We'll know in the next couple of weeks or so. Well, a sector that's gone quiet actually in the last 1 month or so is the steel, the ferrous space, steel, stainless steel. There's a lot of buoyancy, and suddenly the talk has gone quiet, and maybe monsoons, a bit of a slowdown in China as well. Now, you have some holding. I think you'll have Tata Steel in there. You'll have a couple of those smaller players as well, the tier 2, so to call it, Godavari Power and Ispat, Sarda as well, and Jindal Stainless. What is your view on this space? You'll have got in at the right time, but now what's your view? Do you believe that what you're expecting is coming to play, or do you think some of these stocks have run ahead of themselves?
So if you see broadly, we are both positive on both ferrous as well as non-ferrous, but it's not, we all understand it's cyclical, and to that extent, there will be bouts of performance and underperformance. The way we are looking at differently this time is we want to be investors here. And when I'm saying we want to be investors, what I meant is we want to stay and give a lot of time to this sector and these companies because we're seeing something externally changing. As China becomes more prosperous, so China is the largest consumer of metals as well as the largest producer and the largest exporter of metal in general, particularly steel. And as it becomes more prosperous, it will have to decarbonize its steel making. That's happening as we speak in Europe, Japan, Korea. It would happen in China also, slowly but steadily it will happen, which means the cost of producing steel in China should structurally go up over the next 3 to 4 years. And China being the largest net exporter of steel in the world, that means that globally the steel price should be, and applies to many other metals. And to that extent, that's a broad thinking that we have, that as China becomes more prosperous, many of these industries where there is significant pollution clampdown or decarbonization of steel making or the metals manufacturing happens, structurally the metal price should move up over a 3 to 4 years.
Anand, I also wanted to understand, from you about the entire consumption space, because if this is a budget where you have some SOPs for the middle class, lower middle class, then there is a narrative that a lot of the consumption pockets could do well, whether it's retail, names like Trent, etc., whether it's telecom, names like Bharti, whether it is, e-commerce, names like Zomato. But these are stocks that have already rallied quite a bit. So from a consumption angle, how do you play the budget now?
So I think it's a most tricky one. Consumption is everybody's favorite, especially pre-2020. If you see, a large part of the rally was only in B2C stocks. So I keep on telling people that consumption is never a problem in this country. We have favorable demographics, rising per capita income. All segments of the consumption will do well. Some will do 5%, some will do 12%, some will do 20%. But consumption in India is generally a structural story, which also makes it more challenging for stock picking because none of the consumption stocks generally will find it very cheap. So they're always expensive, given that you have a strong history as well as good future to look forward to. And to that extent, one will have to go bottom up. Within consumption, what we like and what we've been overweight is the services part of the consumption. We spoke about telecom, airlines, travel, leisure, hospitals. Those are the areas. Education, we don't have too much listed space out there, but these are the areas where the upper middle class and the rich will spend incrementally more. The products consumption, we have had the penetration. Services consumption, where we can see actually more penetration and faster growth than the consumer products companies.
Got that. The flash at the bottom of the screen, CESC, which we mentioned yesterday, there is a tariff adjustment higher which has taken place, which amounts to a hike, and it should be good to cover companies' incremental fuel costs according to IIFL as they are putting it out. So almost 4% gain on CESC this morning. The other one, of course, is Maruti, which is still up, which is up 4% now. So about 12,486 on Maruti coming through there. Anand, just talk about real estate and what you own there. Do you think, there is a large element of the price appreciation has been so large, right? That there is a lot of investor activity as well now. I was talking to a real estate consultancy and they were saying that it could be upwards of, in some markets like, for example, Gurgaon, etc., investor activity could account for 50-60% of a project sales. There are end buyers, so that is there. It's not as if, it's just all just sort of trading ownership papers, but there is a lot of investor activity now, and that's essentially what's led to this ramp up in prices very, very fast. Just your thoughts, and is that a risk as you see it, Anand?
Indeed. That's the bad news, if you ask me personally, because as I said, infrastructure investment, urban infrastructure investment, housing, and especially the households' investment in housing and manufacturing picking up, all these three are extremely important for the ultimate goal of urbanizing the country. So we have 65% of population in rural India, 35% of population in urban India. If you want to reverse that, and that's the way forward for India to go to 5 trillion to 10 trillion, I think we need all these three. And yes, this is a challenge. And that's why we need to do enormous investments in infrastructure so that the cities expand, and in the same breath, the builders actually can go out, acquire land, and build more out beyond the city centers where the price would invariably appreciate as the demand supply catches up or the demand outstrips the supply in that already developed area. So I think that's one big challenge, but we have examples like Ahmedabad, to some extent Hyderabad, where cities have expanded and the real estate prices have remained soft, relatively soft, and within the reach of the middle class and the households. I think that's very important. So that's where I continue to repeat that we need to continue to invest in the urban infrastructure, keep the real estate prices low, and that's very important. But I think what you're talking about Gurgaon to me is more of a exception than norm as we track. And you have to also see the appreciation is after 7 to 8 years of a soft real estate prices. So yeah, some bit of recovery in the real estate prices is given. But barring Gurgaon, I think the prices are not really shot up to worry as we speak.
Okay. Anand, thanks a lot for joining in and all the best. We'll, of course, touch base with you again post the budget. But until then, stay safe and thanks for joining in. By the way, there's some news on CESC. The company has hiked tariffs. Vivek is here to give us more details on that. Tariffs have been upped by almost 6%. That's important information. Vivek, what are you picking up?
Well, that's right. So what's actually happened is that CESC, which basically operates as far as West Bengal is concerned, this is for the Kolkata circle that we are talking about. The company for a long period of time was actually grappling with much higher costs, and this is something they were unable to recover. The company has had, two major asks as far as, increasing tariffs were concerned. Number one was actually increasing the power tariffs, and number two was trying to go ahead and recover the incremental variable costs that they were facing. So now, as far as the month of June is concerned, we've analyzed the bills. What's actually happened is that the company, since June, has started to levy a fuel adjustment charge to its consumers. What is the quantum of this fuel adjustment charge? It is 40 paise per unit, which effectively means that the tariff for the month of June has been hiked by 5.7%. IIFL, in a sales note, has actually gone ahead and mentioned and given, what will be the impact. Number one, they are saying this should be able to cover CESC's incremental fuel costs and ensure complete cost recovery. Also, they are saying the accumulated regulated assets stay at 3,000 crore to 3,500 crore and will be recovered gradually along with the regulatory approval. They are saying from the stock's perspective, it is a significant development. Remember, the stock trades at a steep discount to Torrent Power, Tata Power as well as Adani Power, and this particular development can help the company's valuation go ahead and get narrowed down to its peer set. So significant development as far as CSE is concerned, not a tariff hike, but a fuel adjustment charge to help recover the cost that the company has been incurring.
All right, thanks a lot for that. Vivek explains why the stock opened up, gap up, and it's holding on to those gains of around 5.5%, holding on to those gains strong and massive volumes on that counter. Well, let's turn our attention to KIMS. The hospital major recently entered into a lease agreement for a super specialty hospital in Bengaluru. It also entered into an agreement for taking land on a 99-year lease for a new hospital in Thane. That was for around 500 crore rupees. To discuss this, how the occupancy trends, expansion plans, and what do they expect from the upcoming budget? Well, we have with us Dr. Bhaskara Rao, the CMD of KIMS, who joins us on the show. Hi, Dr. Rao. Good morning, and thanks a lot for joining in. Well, take us through the first piece of news, the lease you have got into with the super specialty, for the super specialty hospital in Bengaluru. Could you give us the timelines? What is the potential revenues from this particular hospital?
The one which we have taken in PES on a long lease,
Yes.
we are about to start by the third to fourth quarter of this year. And almost it will be done by next 6 months. And we are very happy that we are getting on a lease and a revenue share model with a asset-light model. So we have a good track on the doctors who are showing interest to join into our group. With that, I think we will be doing very well as we anticipated. And there is a lot more gap in that micro market. So we hope we will definitely do very well.
You want to give us any numbers, potential revenue, sir?
So it will be definitely, it's very early to stage once we start and the type of consultants which we are going to do. Maybe what we are looking is in the first year, less than a year, we will be break even in our financials are concerned. Both EBITDA zero or maybe EBITDA positive, may not require a good heavy loss funding in the first year itself. That's what our aim.
Right. No, this is, so Mr. Rao, hi, morning, Prashant here.
Yeah,
so
morning.
you were also working on new hospitals. I mean, there was a 400-bed hospital in Bangalore, which this is different, right? I mean, the one that you're
Yes,
talking about now.
there is two. One is in the Electronic City, which I was talking to about this
Yeah.
PES. There is a education institution. They started a medical college. In that, we have about 400 beds, a super specialty block we have taken on a revenue share basis. With that, because it is becoming an asset-light model, and we are very, very confident that we can able to deliver what we are anticipating. And as I mentioned, that in the first year itself will be EBITDA positive. Second one, we are starting in a Mahanagar, that is in Soul Space, which we have taken a building, and that is also going to commence from first of last quarter of this financial year. And we are very, very confident that that is also going to do very well because the consultants are showing a lot more interest in this group, and the revenue, the doctors' participation in the asset also will give them a good incentive basis to join and stay back and feel that is their own hospital. So with that,
Right.
Both the units in Bangalore, we are very, very confident that in the first year itself, we will be break even.
So by the end of this year, what will be the total bed capacity, sir, across the company?
So as of now, the 3,000, maybe another 1,500 beds we are going to add. 400 in Soul Space and 400 in PES, and another 300 in Nasik. Maybe another 400 is coming in Bombay. These are all the things. Maybe nearly 1,500 to 2,000 will come into the new on the existing beds.
So 400 beds in Bombay, you said. Any more capex that you have planned in Mumbai? I mean, this is
Yeah, that
a
is
lot
in
of
Thane.
Okay.
Thane, actually, we already put the capex. Most probably by January, February of next year, we are going to start commencing that unit. With that, even though we have this is the full capacity of 400 beds in each facility, initially we may be opening about 200 beds and 150 beds. In a 1 year, 2 year period, the entire 400 beds will come into occupancy.
Okay.
Operational.
Apart from Thane, anything in the main Mumbai area, because a lot of your peers are entering into this space as well.
As of now, we are looking into Thane only once because everybody is will be very cautious to get into 2-3 hospitals in Bombay without showing a good progress in Thane. We may not be able to go. We are looking at opportunities, but we are evaluating those things. But once we are confident that Bombay market, what we expected, if we can able to deliver in Thane, definitely we look for another 2-3 places in Bombay.
Okay, and
There is
this
a great
300
potential.
beds, sure. Sir, you spoke about 300 beds in Nasik that you're adding, right? That happens
Yes.
when? In this quarter, or you're looking at the timeline over the next few quarters?
No, we are going to start by end of this month or maybe first week of July, August. Commencing, all the doctors are on board and everything is fine. Just waiting for some statutory things of. Once it comes,
Okay.
we are on the job.
And this 1,500 to 2,000 beds that you will be adding, say, in the next 18 months, right, or so, what does it
Yes.
take your total bed capacity to?
It will go around nearly total bed capacity will be around 5,500, but operational beds will be around 4,000.
Got it. All right. 5,500 operational beds at around 4,000. In the past quarter, Dr. Rao, you had a couple of issues, with regard to the occupancy. You all were doing some kind of activity at one of your hospitals, which explains why the occupancies did come down. Has it got back up, and what should be the average for this year you're looking at? And also on margins, I think there was a one-time 10-12 crore hit that we saw in the past quarter. So what is the steady state margins we should be working with on both these two, occupancies as well as margins?
See, last time the occupancy of the last quarter is one of the facility which we are shifting. That's why there's a little bit delay, and also the operational efficiency has improved. The ALOS has come down. In turn, the average revenue per patient has been increased. With that, I think the occupancy rate has come down. Otherwise, everything is fine. And then the the elections and the rainfall in Andhra, which disturbed a little bit. I think right now the whatever is the one-time expenditure, because all these things we are recruiting people in the management and all, we are putting on to Kim's main listed company. Now we have been segregated and all those things, so that will be able to take that rearrangements of these financials, and this definitely the occupancy and the financials and the cost cuttings have been achieved in this quarter. This quarter will be much better than previous quarter.
And this year perhaps, so for the year, that's FY25, a bit operating profit should grow between 15-20% for the full year?
15-20%, yeah, definitely it will go up to 15%. Because we are also adding few more hospitals, which may not be able to generate any EBITDA.
Right.
But the top lines will be better.
Okay.
Like Nasik.
Of course. What about price increases, sir? I mean, I don't think you've taken any price increases over the last couple of years. Are we to expect one, this year in 25?
We are very, very cautious about the price increase, because we will try to achieve adding new therapies and as well as the volume base. And certain areas this time we are going to increase price hike, and we'll keep on not in a full length for all the areas. We don't increase the price. Where we see in the market there is a lot more gap, that will be able to increase a little bit. Still, we want to keep little lower than our peers in the market.
No, I take that point, but for the cash
little bit
portion.
we have been increasing on certain areas this year.
So, right. So, could you tell us on a overall basis on the cash side, what is the price increase amount to on an overall basis?
See, it will increase about 2 to 3% on the cash and insurance prices concerned.
Just the cash side, sir? What will be the increase?
2 to 3% of the top line.
Okay, all right. When is the last hike that you took, sir? What was the last hike?
2.5 years back.
2.5 years back. Okay, got it. We'll leave it there. Thank you very much, sir. Appreciate you joining us, and good speaking with you here on CNBC-TV18. Good luck. We'll take a quick commercial break here. We'll come back. We'll be joined by Ashish Modani of ICRA and Ankita Shah of Elara Capital. We put the focus on the infrastructure sector. What to expect out of the budget on the 23rd? That's the question. Stay tuned.
Welcome back. Well, the final budget for 2024-25 will be presented on July 23rd. To decode what are the key expectations from the infra space, we have with us Ashish Modani, Senior Vice President and Co-Group Head Corporate Ratings at ICRA, as well as Ankita Shah of Elara Capital. Thanks a lot for joining in, lady as well as gentlemen. Well, Ankita, I want to come across to you first. Before we get to the expectations on the budget, you track Concord, and those numbers look a little bit disappointing. That was one of the top losers on the downside. A quick comment on that. How disappointing were the numbers, and what are you working with for this year?
Yeah, so Concord reported 3% growth on the EXIM side and 15% growth on the domestic front. Now, this is lower than the management guidance expectations that were set. They were targeting a 25% growth on the domestic side and 15% growth on the EXIM. We see overall port volume growth also being muted for the quarter gone by. Even if you look at, container volume numbers of the power and for Adani ports also has been muted. So I think that has had an impact on the EXIM numbers of Concord. But we believe this could pick up in the second half of the year, given that GNPT is expected to get connected in the second half of the year. And Concord could be a beneficiary because they have nearly 70% market share at GNPT. And there the rail coefficient is low at 18%. And post the DFC getting connected, the expectation is that the rail coefficient will jump double to 30%. So obviously the larger market share beneficiary, that is Concord, will definitely benefit out of it. So I think the growth will pick up from second half.
Okay, all right. So past quarter was disappointing, but you're saying that going ahead, you have various triggers in place where things will improve. All right, so that's about Concord. Let's focus on the infra space then. Hi, Ashish. Good morning and good to see you in. Ashish, I wanted to ask you about the railway space. From a stock market perspective, a lot of stocks have been doing well, anticipating better times. from a stock price point of view, maybe majority of the good news is in the price. But in the near term, the budget is going to be important. So give us a few numbers that we should be tracking in terms of railway budgets. What were they? How do you expect them to pan out?
If you look at the last interim budget, the overall hike that was there, that was pretty modest. But if you look at it in isolation, it looks modest. But if you compare it with the FY22 level, last FY23, it was a bumper hike, around almost 50% plus. So if you look at it in the totality over the last few years, the share of not only railways and roads, both of the segments has increased substantially. And given the focus of government to reduce the logistics cost and ease of doing business, there is a lot of impetus on the railway as well as on the road segment. So all the entities in this two specific space, transportation space, are expected to do reasonably better than the other segments over the next 2 to 3 years. And what we are also expecting is regarding the freight related thing, with DFCC now becoming fully operational. So a lot of activities are happening now. The government is also talking about multiple other dedicated freight corridor while still in the progress, and it will take some time for them to capitalize. But in the interim, what we are expecting in the railway pies is on the wagon space. Wagon players are sitting on a very strong order book, and they are expected to do very strong in the next 2 to 3 years.
Okay, morning both of you. Ankita, now, so at the margin, right, and markets, of course, move on incremental news flow. At the margin, expectation is that because over the last 4 or 5 years, spends on infra has been so strong, and now there is a bit of a change in terms of government. Maybe it'll be a little different. It won't be business as usual, etc. Actually, even in the interim budget, if you saw allocations, if you looked at specific sectors like roads, etc., the growth was very, very moderate. That is FY25 BE. Do you expect anything different when we get the full budget, specific infrastructure sector allocations, or do you think they'll be around or in line with what we saw in the interim budget, which was moderate increases and sharply lower growth as compared to 24 over 23 or 23 over 22?
So we expect the growth could be higher than what was put out in the interim budget. Reason being, the government has had very robust tax collections plus dividend from RBI. So there could be a midway between fiscal consolidation and the capex push that the government will go ahead with. So we believe there could be a uptick in the capex numbers that were announced in the interim budget, because we need a clear roadmap for our economy to become the third largest and USD $5 trillion economy. So for that we need the required capex push, not just in roads but railways, airports, urban infrastructure, energy sector, and along with it sustainable development infrastructure. So I think there will be new sectors.
Okay. And do you think stocks need a higher allocation because stocks have done well across these sectors, right? So if budget has to be a trigger, the absolute allocation has to be higher than the interim budget for each of these sectors? I mean, for stocks to do well from here?
I think stocks are already pricing in the expectation of a growth. And that is why, despite order inflows not being very strong in the FY24, like previous year, because of, the elections and, model code of conduct and, those things. But already the market has started discounting on the expectations of higher order inflows going forward. So I think that should now flow down into numbers and actual inflows coming through for companies. So I think there will be earnings upgrades that will be coming in now. I think the PE re-rating has already started.
Okay, all right. Interesting. PE re-rating done, but now earnings upgrades is something that we look forward to. Ankita, any numbers you're working with that we should be looking forward to in the budget?
In terms of
allocation,
growth
in terms of allocations, budgetary announcements that you are working with, that you have already penciled in. So then we have, a reference point when those numbers do officially come out?
No, we do not have exact, numbers put out, but we expect it to be higher than what it was announced during the interim budget.
All right. Any percentage, how much higher, or you have not yet worked on that?
No, we've not put out on those numbers.
All right, Ashish, I want you to comment then. If in case we need to be tracking a couple of, crucial announcements, which would be your top 1-2 pointers that you're looking forward to in this budget, and what could it mean for the industry?
See, our house view is that ICRA, we are expecting that overall capital outlay will remain more or less at a similar level what was highlighted in the interim budget. Because if you look at April and May, it was already down by almost 14% year on year, that 2 months combined. So, and monsoon, that quarter 2 is generally a lean quarter. So a strong ramp up is required in quarter 3 and quarter 4 to even meet the interim budget estimates. So we are not expecting a meaningful change in the capital outlay, but there is around almost 70,000 crore buffer that is allocated in the new schemes, which can be reallocated between various ministries. So that is something that we really need to watch out for, how this 70,000 crore will get allocated. Because if you look at the delta from FY24 to FY25 budgetary estimate, out of 1.6 trillion rupees, 0.7 is coming from this new scheme itself. So how that will get reallocated, that is something we want to see. But we are not expecting a material change in the overall capital outlay at ICRA.
Okay, all right. Ankita as well as Ashish, thanks a lot for joining in and filling us in with your expectations with regard to the budget. We look forward to touching base with you all and see how, what the announcements come and what were you all expecting, what's the deviation out there. But for the time being, thanks a lot for joining in. Well, the markets are holding well in the green and we have earnings. That's the big trigger going ahead. So it's time for our special segment, Quarter Se Quarter Tak, where we bring you the key expectations from each sector. Today, Mangalam joining us to tell us what are the key expectations from the FMCG pack. Over to you, Mangalam.
Well, the way the stocks are moving and the way, things are happening in the FMCG pack right now, after a spate of poor results, this time around the street actually anticipates a gradual uptick, especially in demand conditions for rural demand. That has picked up due to contained inflation, many months of contained inflation now. More importantly, going forward, the outlook is as well good thanks to predictions of a normal monsoon, higher minimum support prices, and also consumption incentives that are expected this time around ahead of the budget as well. But remember, this was also the quarter where we had, the elections, etc. So sectors such as paints and building materials, labor-intensive sectors could be impacted by the elections and the ongoing heat wave. But on the other hand, we would see a demand pickup for names, categories like cooling oils, soft drinks, talcum powder, ice creams, etc. What we know from the updates so far is that consumer staples have seen gradual recovery. Dabur said the India business is likely to record mid-single-digit growth. Marico saw modest uptick in domestic business as well. Both of them together saw operating performance, improve over last year and faster than revenues. So that meant margin, expansion as well. And we also got Godrej Consumers numbers saying that there was high single-digit organic volume growth and double-digit EBITDA growth in India as well. For retail, there are signs of recovery. Both D-Mart as well as V-Mart reported mid-teens, slightly higher than mid-teen sort of growth. 18% for D-Mart and V-Mart 16%, implying positive same-store sales growth as well. And finally, we had updates coming in from the jewelry sector, which was very interesting because we had Titan, which saw a growth of 8%. Kalyan saw a growth of 29% and Senco retail sales were up 11% as well, telling you that the larger player out here has slowed down when it comes to growth. In the personal care and beauty segment, Nykaa's consolidated revenue expected to grow 22 to 23% this year, led by beauty revenue itself, which is growing 22 to 23%. The fashion industry, however, continues to face challenges, and that's exactly what's going to reflect in their numbers as well. What are we expecting in terms of revenue growth and margin changes for key companies? Tata Consumer is likely to be the pick of the pack with a 15 to 16% revenue growth, margin improvement as well. Middling sort of revenue growth for Britannia and ITC. Nestle is likely to show growth of almost 8 to 9% on the top line, with Hindustan Unilever and Asian Paints actually being laggards for the FMCG space. We have Asian Paints where the revenues may decline by about 2% as well, with Hindustan Unilever about 1 to 2% growth in the revenues. The likely outperformers this quarter, and the ones that I'm clearly keeping an eye out on, have to be names like Varun Beverages, benefiting from the strong heat wave, United Breweries as well, improved margins. Imami is the other one. We have brokerage upgrades coming in as well, and there has been noticeable uptick in consumer sentiment, so names like Honasa and Jubilant Foodworks really stand out as well. And finally, with the up move that we've seen recently, the valuations for FMCG space, they've never been cheap, but this time around we have seen some moderation as well. So for names like Nestle, Tata Consumer and Godrej Consumer, these stocks have been outperforming. Valuations are between 60 to 71 times. But for Marico, Dabur, Hindustan Unilever actually is now at a level which is what it was trading at, say, for a 5 to 10 year average as well, at 54 times. So that's all about the FMCG space this quarter.
Okay, thanks a lot for that. Very helpful there. An uptick in demand is expected given that things are picking up across the rural areas, and the expectation is of a good monsoon as well. Abneesh Roy, Executive Director at Nuvama Institutional Equities, is with us. Abneesh, hi, good morning. That was a pretty exhaustive, report that Mangalam put out on the expectations there. But if you had to pick and choose, which are the stars of the earnings season this time around? Which companies could be the stars this time around?
Sure, thanks. Yes, the updates in the FMCG 4 have come, and in the retail around 5 have come. In the FMCG space, the volume growth, etc., sales growth and margins all are in line with our published numbers of Q1 preview. But in the jewelry space, clearly Titan has disappointed Street. We had downgraded Titan stock a few months back, and we see slightly more pressure there. So clearly, studded has also grown slower for Titan, so the margins will be under pressure. Coming to FMCG, yes, the results are decent given the heat wave, lack of marriage days, elections impacting liquidity, and definitely manpower also in few sectors. I think the results updates are decent, but the sector is benefiting because of sector rotation from the investors. If you see the kind of up move we have seen in the sector, in the stocks in the last 1 month, 2 months, I would say that we had already called that out, but good to see that before actual full recovery, we are seeing a lot of the stocks show that. In terms of Q1, definitely we expect that there will be few companies which will see very strong numbers. So clearly Varun Beverages, Imami, Godrej Consumer, Marico, Dabur, etc. all have seen decent number. Even Adani Wilmar is seeing good recovery. So we expect Adani Wilmar next 1 year should be very strong, good volume growth and pricing also coming back. But from the bigger companies of the sector like HUL, ITC, Asian Paints, we expect weak performance in Q1. But in those stocks, the valuation comfort is high. So if any investor wants to play the consumption revival, but is willing to wait for the Q1 weak numbers of these three companies, I think post the results, it's a very good time to accumulate HUL, ITC, Asian Paints also, but from a 1 year perspective. But from a near-term perspective, our topics will be essentially companies which are doing well in the near term. So Varun Beverages, Imami, Britannia, Godrej Consumer. We also like Nestle and Bikaji in that. But United Breweries will be impacted negatively in Q1 because of the election-related impact. So there are slightly weak numbers there.
Okay, all right, Abneesh, thanks a lot for joining in. And good call on Titan. And you're saying you continue to remain negative. The stock has seen a lot of pressure. What's the target price you have on Titan? And I think on the flip side, Imami, y'all were one of the first to call out, I think, that things are turning for them, and y'all were quite positive. What is the target price out there? That's been a big mover, Imami.
Yes, Imami, we expect that in Q1, you will see close to double-digit sales growth and strong volume growth in most parts of the business, except Kesh King and in their Fair and Handsome portfolio. Those two will see a YOY dip, but rest of the portfolio will be very strong for Imami. Even HPC will be strong. And we expect that in the coming 3 quarters also, because Imami has almost half of the business, India business, from rural, we expect double-digit sales growth and double-digit EBITDA growth to continue for Imami. So we remain positive. The stock has moved up very sharply in the last 1.5 months. So we will be looking to upgrade our target price when the next note comes. But we see that 15-20% kind of upside from here also is possible in Imami. Because still, if you see, even after this up move, the stock remains relatively cheap. in spite of a double-digit kind of a sales growth and EBITDA growth coming back to the business. International is also doing well for Emami. On Titan, we see that, yes, even Q2, we see weak numbers. So Q2, if you see, base margins are quite strong. Yes, marriage days, there will be some recovery. But in terms of overall sales momentum, we see Kalyan growing faster given the franchisee addition is very strong. So we remain underweight on Titan. Our sense is, although stock has corrected meaningfully, next 3 months, there is a lack of trigger. I think H2 is the time where the marriage days and a lot of the gold pricing impact, etc., will be behind. But concern on lab-grown diamond remains, as of now, that remains a monitorable. So we see that from here, maybe the stock correction on absolute basis is limited, but time correction is possible. But from a 1 year perspective, after Q2, I think the stock can give 10 to 12% return, but Q2 results will also be weak for Titan in our view.
Got it. Got it. One of the top ideas I think you have, which you have sounded positive on, was Godrej Consumer. They came out with their quarterly update and I didn't see any big problem out there, but maybe the stock ran up in anticipation. It's currently down more than 2%. You continue to remain positive out there. And what was your analysis of the operational performance?
Yes, Godrej Consumer stock had run up. You're absolutely right. The update was exactly in line with our expectation. So yes, what are the weaker points of the results? Because there are a lot of strong points in the numbers. I think in Africa, the double-digit volume dip is a proactive step by the company because they are looking at a profitable business in the Western Africa, where they have taken proactive steps to cull the loss-making businesses or low-margin business. That's a proactive step. We expect Africa business to come back to low single-digit volume growth from Q2. I think that was a slight negative. The other negative we had already called out in the preview that house mosquito repellent business in Q1 will be flat on YOY basis because of the heat wave. We expect that a disruptive launch in mosquito repellent will happen very soon, and that will be a key monitorable for the stock. If it does well, we can have a double-digit growth in mosquito repellent visibility from next quarter. But if it does not do well, then I think the stock would correct a bit. But it remains a strong top-tier performance in this quarter. Also, Q1 was a strong performance in most of the key parameters.
Okay, thanks a lot for that. Well, that is what you can expect from the FMCG space. Let's slip into a quick break. On the other side, we'll put focus on the commodity space with Manisha Gupta. Stay tuned. Welcome back to Bazaar Morning Call. Well, for now, Mitesh Thakkar is joining us to give us an indication of which way things are headed. Mitesh, hi, good morning. What are the stocks you're looking at? And overall for the market, very quiet.
Sonia, the market view remains the same, very range-bound and compressing kind of a movement. Though the Nifty is mildly positive, the Bank Nifty is very flat. So I think this is what I expect next few days. And on the stock side, I think Maruti, after a long time, has turned positive today. It opened with a tap up and then it's seen follow through. So they should head towards highs of 12,950, 13,000, and I would recommend a buy with a stop below 12,250, 12,300. And the other one which I like is LLT Larsen & Toubro. That's a buy with a stop at about 36.30 and a target of 37.25 to 37.30 can be looked at on the upside.
Okay, well, thanks a lot, Mitesh, for that. Let's shift focus now to the commodity space. Manisha Gupta is joining in. Manisha, what's the one commodity you're tracking today?
Well, Sonia, I'm looking at the rubber prices, which actually have been doing quite well in the recent few months there. If you look at the Indian markets, we're looking at 200 rupees per kg of rubber prices there. Well, and this is the highest that you've seen in last 12 years. In last decade, we've seen rubber prices trade anywhere between 130 to 160 on the higher side. But the last 6 to 8 months have actually been quite positive, bullish as well. And we have seen rubber prices, not just in the Indian markets, but international markets trade on an year-on-year higher basis there as well. So lower production due to heat waves and, of course, lower productivity and yields is what really has supported the prices there. The markets also are looking at higher demand for natural rubber prices from the AV industry, tire industry, and that has been supportive. When you look at the Indian natural rubber stock, if you look at it on a March-on-March basis, we have seen a decline on this. So if last year was 442,000 tons, it's at 372,000 tons on 1st of March 2024, and that is what has been bothering the markets there. Also, when you look at the Indian rubber production and consumption numbers, the last couple of years have seen an increase in production, as you can see, but the consumption numbers have increased many-fold, and that tells you that the import dependence that India has in sense of rubber and natural rubber will perhaps just about continue. I also want to talk about the global markets there, and this is the data from Rubber Study Group, which says that the global production in 2024 is expected to increase by 1.1%, but the consumption is expected to increase by 3.1%. So in the global markets as well, we are looking at a deficit kind of a situation there, and that will be supportive for the rubber prices. The demand growth, as I said, is continuing to come in from China. That is, of course, leading. But the Indian demand growth is gaining up by 3% for this current year as well. When you look at the international markets, well, we have seen a stronger demand there as the numbers show. But here as well, there are concerns on production coming in from Thailand, a major producer of rubber, by the way. And then the China factory activity in the previous month also has surged quite strongly. Our latest report shows that there has been 3 China, EV makers who have done record sales of automobiles in the month of June. So that tells you that the demand has been on the stronger side and the rubber prices could be supported going forward.
Okay, thanks a lot for that. Well, that is in the commodity space. But I also wanted to quickly talk about the big stock in focus this morning, which is Maruti. Maruti is now up almost 4.5%. And if you're wondering why, the Uttar Pradesh government has waived off the registration fee on any hybrid car that you buy. And because of this, 100% waiver on the registration fee of the hybrid cars, the potential benefits that consumers can have is up to 3.5 lakh rupees. So that could be a big boost to the sales of hybrid cars as well as overall demand in states like Uttar Pradesh. This is positive for Maruti, Honda, Toyota that manufacture hybrid cars. Maruti, as we know, offers the Grand Vitara as well as the Invicto in the hybrid car category, and names like Toyota offer, a couple of others in that space as well. Now, this waiver is to boost hybrid car sales and increase the market. UP is a major market for passenger vehicles. If you look at the data, right, the passenger vehicle sales in the first half of the calendar year in Uttar Pradesh saw a growth of 13.5%, coming in at 236,000 units. This is also a potential positive for Mahindra & Mahindra because the Mahindra Group is investing 1,200 crores in renewable projects and is setting up a 150 megawatt hybrid project as well. But if you look at just the hybrid car category, it's very small currently. Just 2% of the overall volumes of the passenger vehicle space come from hybrid cars. But yes, this is a big positive, and hence Maruti stock is up almost about 5% right now. Let's step into a quick break. On the other side, we'll be joined by Puneet Chatwal, the MD and CEO of Indian Hotels, to discuss the demand and the business outlook. Stay tuned.
Well, it's corporate radar time now. The Indian hotel stock is up 61% year on year and 40% year to date. But if you only looked at the past month, the stock has lost about 10% from its recent highs of about 660 rupees. There are some concerns about how first quarter may have panned out for the company, since a year ago in the same quarter, the company benefited from the G20 meetings. In fact, they benefited all through 2023. Now, this summer was hit by one of the worst summers as well as election season. But all that is behind us. To get an idea of the year ahead as well, I have with me Puneet Chhatwal, Managing Director and CEO, Indian Hotels. Good morning, Mr. Chhatwal. Always a pleasure having you with us. Well, let me start with this minor sell-off we have seen in the stock. And when I inquired, some worries that last year was such a spectacular performance that it may be tough to repeat, given that you don't have G20. Is that a fair worry?
All worries are fair. All risks that are, kind of tabled are there. But the job of the management is to navigate through all kinds of headwinds. As in the past several years, I remain cautiously optimistic about the guidance that we have given. And the guidance that we have given is a 10% growth in the top line over last year, with or without G20. And we think we are on track. And as you rightly said, a very difficult heat wave that the sector went through, and a very challenging period because of code of conduct. A lot of business, especially in the metros, comes through the government sources. So I think all in all, that is behind us, and we are very happy and looking at the pace of development. The business on the books for the month of July and August gives us the optimism not to change our guidance, but to give even a more solid guidance in terms of double-digit growth on the top line at the end of this financial year.
Well, double-digit is a big range. If you can say something about mid-teens, high teens.
But I would say anything north of 10% to 15% on the top line is good. And if it is driven through some of the important sources of contribution margin, that is like rooms revenue, or through your main wedding business, then it translates into incremental profitability, because that's how this business is in terms of a fixed cost base. And on that front, Lata, I forgot to mention, this year, based on the calendar, the first quarter had the least number of wedding dates too. So we had the heat wave, the least wedding dates, and code of conduct, all three. But I think the sector in general did well in terms of navigating through this. And I remain optimistic as we are in a silent period that we will be fine over the 12 months period in the guidance that we have given.
Okay. Would margins also be better? I mean, you already did fantastic margins last time, I think north of 20%.
For the year, we did 33% almost. So I think anything north of 30 for the full year is a very good industry-leading margin on a global front. We should not forget we have also hotels in US and London and Cape Town, and it's not just a domestic. On the domestic front, on standalone, we are north of 40. And I think that's a very respectable and a very high margin for the kind of business that we are in. And we have been very confident in giving this guidance, and we stand by that.
Oh, 40 is something to kill for, Mr. Chhatwal. But, as you pointed out, I think a couple of interviews ago, that there is a supply-demand mismatch. Supply is lower than demand and is likely to remain that way for a few years now. But does that give you unlimited pricing power?
No, I think there is nothing like unlimited pricing power that will come. But definitely, if demand outpaces supply, especially in the key hospitality markets like Delhi, Mumbai, Rajasthan, Goa, Bengaluru, etc., then your ability to charge is higher. And I think that is the situation that we are in. And also our footprint is so large in these markets. We are industry leading in, Goa. We have 15 plus hotels in Goa and another 30 plus homestays. So I think given that kind of a footprint, the importance of these markets is very significant for our portfolio. And I think they will keep doing well because although the supply is coming, the demand is just outpacing the supply.
Oh, yes. Oh, yes. A visit to the Gateway, to the hotel in Gateway, you know, you're a stand for place in even Shamiana. Well, let me come to ARRs. I know it's silent period, but how much can you reveal? I think ARRs can be revealed. How was it, or how do you see it in the current year? Last time, I think you did 75%.
That is the occupancy, right?
Yes, yes. Sorry, occupancy. I'm sorry. I meant occupancy.
We are, as I said, 10% top line growth. If half of that is coming through rooms and the other half is coming through food and beverage, then obviously it has to be more than last year. What exactly it will be is really decided between the months of October and March, because that is the time when you benefit, especially our portfolio, from foreign tourist arrivals because of our palaces footprint with the Taj brand. That is the time when you have the maximum corporate events because of the weather in Delhi and in Mumbai and other places. So that rate improvement and the average that you derive is really coming from the months of October to March. Okay. And we should not forget, this sector till 5 years ago was used to having a negative first half of the year. Now, you look at just Indian hotels for the last several years, except for COVID, we have been profitable in Q1 and Q2, which we were never historically. Yeah. So I think that is where the landscape of hospitality has changed. And it's not just us, all the companies that are publicly listed announcing the results are on, are really on the go from 1st of April onwards. And that is a dramatic shift in the way business is done in this sector.
Okay. Well, actually, the FY24 ARR, I think, was about 580 odd. You can do substantially better?
See, Lata, I think it's a very good question. So let me answer it in a very, scientific and artistic way. We have several brands. We have to start giving this guidance, which we'll do when we announce the results for the first quarter. By brand, the ability to charge for Taj, which is a 120-year-old brand, which is so mature, which is like the crown jewel of India, not just Indian hotels, is very different than our new businesses. So when we say that 12,000 is the rate, that doesn't mean that was the average achieved rate of Taj. So that includes the Ginger, that includes the Vivanta, that includes Selection, all other hotel brands. And now in August, we're going to launch also Gateway. Yeah. So I think the guidance has to be by brand. And if the growth of Ginger starts in the way we have been thinking it should, like adding at least 10 to 12 a hotel a month just with the Ginger brand, then it starts diluting the overall average achieved rate, because a Ginger brand would do like 4,000 or 5,000 rupees as an average rate, whereas Taj would do north of 15,000. So I think that's what the rate you mentioned just now includes rates all possible. And just Taj, I would say, would be higher than or north of 15,000.
Oh, okay. Well, I'm trying to pack in as much as possible, being warned by my producer. 2 questions. Wellness, are you all going to go big? Because, just as the summer is a big reality, people looking at not just luxury, but diet and good health is. So any plans over there? And the other one, international. Why is it so much less than your domestic, and any plans there?
Both great questions, Lata, and thank you for asking. We have always had what was called the Jiva. We have renamed it or rebranded it as the J Wellness Circle. And the J Wellness Circle enables us to have more than 80 spas across our portfolio. That is maybe the highest anybody would have in the world. But that's not the end. It's just the beginning. And we are looking at various options going forward in partnering with people who are very strong in wellness and in that kind of sector, because that's a very specialized sector. So we want to bring in our expertise on hospitality in terms of accommodation and combine our forces with somebody who's very strong on that front. So hopefully within a year or so, we'll be able to guide more on where we stand on that front. When it comes to your second question was related to
international,
which I said is great, is let's not forget, US is not yet recovered to the pre-COVID levels, especially New York, where we have where we are present on the Fifth Avenue. But even UK, London has been a very big contributor to us for several years now. And we know what UK has gone through in terms of also elections, and they had their own challenges. But we do believe that London will keep doing very well. Cape Town has done very well for us. And we did have some challenges in the past in Sri Lanka, which is bounced back very well. But at the same time, we have still some challenges in Maldives. But I believe now that Maldives is beginning to stabilize. All in all, international has done well for us in the last 16, 18 months and will continue to do and contribute much better. And that's one sees, when you see the results on a standalone and a consolidated basis, you see that what the domestic contributed and what the international contributed. International historically was a drag, which is not the case anymore.
Okay. Well, actually, my producer is extremely impressed by your answers, and she's given me one more minute. What are you all doing about digital? I mean, there's so much talk of AI, and you have customers on whom you can use digital tools. What's the digital journey?
I think digital, as they would call it in Latin, is conditio sine qua non. I think nobody will be able to survive over long term without using digital and AI as an enabler. Especially for us, I call it as an enabler because when people go to our palaces and our fantastic luxury brands, you know, I don't know if, I think it'll be appropriate to mention here on your channel, Taj was rated as world's strongest hotel brand by Brand Finance for the third time in the last 4 years, and India's strongest brand across all sectors. I think digital remains an enabler, a very important enabler, but it is our service ethos, it is our passion for hospitality, it is our cuisines, it is many other things that we bring together, and how we use digital to communicate that with our customers is going to be the key. At least in the short to medium term. In the long term, I think brands like Ginger will be, or our new businesses as we call it, Ginger, our homestay Ama, or Cumin with our home delivery. These are absolutely digital driven businesses. And it's on a good journey, opening your room key with your mobile phone,